Good morning, everyone. I'm Mark Allen from Gaper.io, and I'm pleased to announce today Angela Lee, the founder of 37 Angels. Good morning, Angela. How are you?
I'm great, Mark. Thank you so much for having me.
Oh, thank you for joining us today. I'm going to start right off with why 37 Angels? Why not 45 Angels?
Yeah, it's a question we get often. So one very practical reason is obviously we had to get a domain name. But the other reason is that when we started, only 13% of angel investors were women, and we wanted to close the gap from 13% to 50%.
Ah, very cool. Makes sense. So today what we're going to be talking about is the unveiling the art of due diligence in early stage investing, and obviously angel investors, so that's what they do. So why don't we start with, can you explain the importance of due diligence?
Yeah, so I could talk about this for a very long time. I wear, I would argue, a couple of different hats. So I'm, a professor at Columbia Business School where I teach venture capital and talk about this. And then I'm the founder of 37 Angels. And then I also am a venture partner in a couple of different venture funds. But in terms of the importance of due diligence, I do think that there's this fallacy that investing, especially in early stage startups, is just this kind of like, I'm going to magically figure it out. It's based off of your gut. It's based off of finger to the wind. And I think it's really important to have a framework and a rubric so that you are not led by bias and 100% by your gut.
Mm-hmm. I would agree, and I would say it's led by your familiarity with the person you're investing in. It's very often it's family and friends, right?
So it depends, right? I think if you are an individual angel that you're just, looking at a couple of deals a year, it often is friends and family. But there's a reason why that round is called the friends, family, and fools round. I think most people who do it professionally, it's actually strangers. So we look at about 2,000 deals a year and invest in 10. And so I do not have that many friends and family. I'm not quite that popular. And so the vast majority of who we invest in, they are strangers.
Oh, very cool. So can you tell us the key components of a due diligence framework?
Yeah, so I like alliteration. And so we think about the four P's. We think about people, problem, progress, and price. People, of course, being the team's domain expertise, whether or not, they have the it factor that makes you think that they can really be successful in the ecosystem. Problem is how large is the market they're investing in? What does that competitive landscape look like? Progress is, do they have customers? Do they have revenue? And then price, of course, the deal terms have to be fair, and that changes month by month.
It's interesting. So, and you mentioned that you're also a venture capitalist. So what are the key differences between early stage investing and, some of the other ones? I'm assuming you do series A, B, and C, correct?
So I would say the main difference between an angel capitalist and a venture capitalist, versus an angel investor versus a venture capitalist, is that angel investors are investing their own money and venture capitalists are investing other people's money. And so that tends to mean that angel investors are writing smaller checks and that VCs are writing larger checks. Also, angels have a lot more latitude in what they invest in, right? So if I want to invest in a social enterprise company that might have lower financial returns, I can do that. But if I'm wearing my venture hat, then I have fiduciary responsibility to my investors to return the fund, ideally to triple the fund. And so we have a little bit more constraint on what we invest in. That said, in terms of stage, both angels and VCs will invest in pre-seed and seed. I would say Series A and beyond, you really only have venture capitalists playing.
Very cool. So can you give us some practical insights and some case studies that you have done with 37 Angels?
Yeah, so I think one of the companies that we are really excited to be investing in, and it just gives you a sense of what it means to invest in the ecosystem in terms of the risks and rewards. I think one of the things that's really difficult people to understand, especially as an angel investor, is that you have very little control. We are typically only going to own about 1% of a company. VCs will own up to 20%. So while they have a little bit more control, it's still not majority ownership the way private equity might work, for example. So we invested in a company called The Lobby, and The Lobby is a startup that basically helps students do informational interviews, internships, coffee chats with tier one firms, right? The Goldmans, the McKinseys of the world.
Mhm.
And that is what we invested in. Fast forward, a few months, we get an email from the founder and they say, we are going to do a really big pivot. And the pivot that we are going to do is we're going to go from The Lobby to Nuvo Cargo, and we are basically going to start doing trucking and supply chain management software. huge pivot. And the interesting thing is, as a founder, they have the right to pivot. And so that is, we have very little control over what the founder does. Now, the founder is phenomenal and was lucky to have, a lot of funding available to him. So he actually offered all of us, our money back. Most of us kept our money in, myself included. The company's doing really, really well now. They're worth, hundreds of millions of dollars and doing fantastically. But it just gives you a sense of the roller coaster it can be to invest in this ecosystem, and to recognize that we as investors do not have control the way we might do in other asset classes.
Interesting. So, which brings up the interesting point. You talked about the 4 Ps earlier. It sounds like P is the most important one of those. Is that correct, or would you differ from that?
I mean, I think they're all important at the end of the day. I would say they are in order of priority. So I would say people first, then problem, then progress, then price. We're never going to invest in a company because it's cheap. It's kind of like you never want to buy an asset just because it's on sale. You're not going to like it when it gets home.
I see. And I guess to P, the last P, price is always negotiable, or correct?
It certainly is.
Yeah. So tell me, you personally, like your typical day, are you generally looking for companies or for angel investors, or a little bit of both?
I mean, I spend most of my time being a professor at Columbia Business School. So
Okay.
if we remove that part of most of my day, which is talking to and hopefully getting to shape bright young minds, if I just take my investor hat, I would say my time is probably 25% sourcing deal flow. And so what does that look like? It means I'm, going to a lot of events, I'm meeting with other investors. About half of our deal flow comes from other investors, right? So it's from people in our network. We have relationships with about 500 VCs and investors, because obviously the best deals are going to come from people who are also investing in that deal. So that's about a quarter of my time. I would say about half of my time is focused on diligence, right? So again, we're looking at 2,000 companies a year, investing in 10. It's a lot of meetings, a lot of diligence, a lot of reference checks. And then I would say the final quarter of my time is focused on supporting our existing portfolio. So we're invested in about 105 companies. And as you can imagine, they sometimes need help with hiring, with fundraising, with strategic partners, with acquisitions, stuff like that.
Wow. So, I mean, it's interesting. You're a professor at Columbia and all of those things. When do you sleep?
Well, luckily the two are very synergistic, right? I'm a professor of venture capital, and so basically everything that I do outside of Columbia just becomes stories and more data to share in class. And
Cool.
I happen to really love both sides of what I do.
Yeah, well, I could imagine. Yeah, I mean, it's actually the best of both worlds, because you're shaping young minds, and also, and I would think, do you ever get, like, from your school, from your classes, do you get people that you then invest in eventually?
So I am actually not allowed to invest in current students because there'd be kind of a bit of a weird conflict of interest. That said, in terms of alumni, absolutely, we have definitely invested in some Columbia Business School alumni.
Yeah, so yeah, they do eventually graduate, hopefully. So,
They definitely do.
yeah, and I can understand why you cannot invest in them, while you're their professor. That does make sense. So closing thoughts. What do you think are your closing thoughts, and what would you say for anybody that's interested in becoming a 37 Angel?
So I would say, if you're just interested in investing in general, the first thing I would say is to get out there into the ecosystem and just start hearing pitches, because this is one of those things. It's kind of like you can't learn swimming from a book. You really can't learn sort of investing by reading about it. You got to go out there, hear pitches, and start to kind of build those muscles. And then I would say, if you're interested, we actually have a resource at 37angels.com/download, which is the 4P diligence framework in one page. If you want to look at that diligence framework and start applying it. And then the final thing I would say is find your tribe. Find one or two other people that you can go to these events with, hear pitches with, discuss them with, because it is one of those things where I think it's so helpful to have other people to learn alongside.
Yes, and I noticed you do have a couple of boot camps coming up too. Would you like to plug
Yeah.
those?
Yeah, of course. So we teach people how to invest in early stage startups. And so if you go to 37angels.com/bootcamp, you can learn the art of angel investing. How do you diligence? How do you source? How do you negotiate term sheets? How do you value startups? And we have one that's online coming up between May and July. And then we have an in-person one coming up in mid-September as well.
Very cool. Well, Angela, I want to thank you for your time today. I'm sure you're a busy lady, so I'll let you get back to one of your day jobs. So thank you very much.
Thank you. It was great chatting.